right, guys, it's Angelo Christian in here today. Thank you for checking out another edition of Real Estate Insider. And today we're going to be talking about breaking down closing costs and explaining exactly what they are. Every single week we get hundreds of phone calls, people calling us to find out what exactly are closing costs, how do they work. Can you explain them to me, Angelo? And, a lot of people, they get very confused on the process, what all the fees are. And so I thought it'd be a great idea, after getting thousands of requests from people on explaining exactly what the closing costs are. So today, that's actually what we're going to be doing, is breaking down the closing costs, so that way you guys can understand exactly what they are. So that way, whenever you're buying a home, you know what to look out for, what the right fees are, what the expectations are. So that way you're not getting screwed or ripped off, and you understand exactly what they are. Because closing costs can vary from one company to another. And some companies have junk fees, and you're going to want to know what those fees are, so that way you're not getting screwed, and you understand what the actual fees are and the difference between closing costs and down payment. So that's really the whole idea behind this segment today, is to shed light on that, so that way you have a very clear understanding about what the settlement charges are. So that way, if you're buying a house, you know what your expectations are. You're not going to spend $10,000 in closing fees when maybe they should only be $6,000, right? Or, because that way you're going to know, hey, how much are my closing costs supposed to be? So that way you're not getting conned or screwed. And also, not just because of that, because you want to understand exactly what they are. So that way you can set your expectations right, and that way you're getting the best bang for your buck, the best deal. Does that make sense? Because that's what the purpose of this is today, is to explain that. So basically, we're going to have all this is going to be displayed on the screen for you too, and you can actually download a copy of the loan estimate. And that's one thing that you're gonna see when you buy a home, something called a loan estimate, and that's going to break down all the settlement charges, and it's going to show everything, right? And your lender is supposed to provide that to you, so that way you know how much all the settlement charges are, the closing costs, and the terms of the loan. All right, so that's called a loan estimate. You'll see a copy of it here. We'll pull it up here in a second and go over. We're not going to do it right now, but we will here in a minute. But the first things I want to bullet point, step by step, talk to you about what type of closing costs are involved when you're trying to buy a house. So the first thing that I want to bring up is an appraisal fee. When you're buying a house, you have to get the home appraised, all right? And this is to determine the value of the home, right? And this fee ranges anywhere from $400 to $600, right? This is for the appraiser to come out there to appraise the property to determine the value of the home, to make sure that you're not overpaying for the property. And normally the buyer pays that out of pocket. It ranges from $400 to $600, and it's a one-time charge to determine the value of the home. All right, that's usually paid prior to closing, and it's paid by you. It's ordered by your lender, and it's done by a licensed appraiser. All right, so that ranges about $400 to $600 for an appraisal fee. The next fee is called an inspection fee. This is different from an appraisal fee. The inspection fee ranges anywhere from $250 to $400. This is for a licensed inspector to come out to your house to inspect your home, to ensure the integrity of the property, framing, electrical, plumbing. Now, this is not a required inspection. It's highly recommended that you get an inspection to ensure that the house is kosher and that there's no problems. But it's definitely recommended that you do that to make sure that you're not buying a house that has a cracked foundation, because the appraiser really doesn't check for that. And that's typically also paid out of pocket by you as the buyer, right? So, and it's called an inspection. And there's a few different types of inspection. This is a general home inspection, and you can pick anyone you want to do your home inspection. You cannot pick anyone you want to do the appraisal. That has to be done by an approved appraiser licensed by your lender. So you can't do your own home appraisal or hire your own appraiser. You can choose your own home inspector, okay? And it's not required, but again, it is recommended that you get an inspection. So now, if the home has a well, a water well, or a septic system, or it has a problem with the foundation, this will warrant further inspections that will be required. If the home has a water well, they're going to want to do a sanitation test on the water well. and the water well has to be at least 100 feet from the septic system. If it's less than that, you could have a problem getting financing. If like the well is 50 feet from the septic, that could be an issue. So you want to make sure that the water well is at least 100 feet or greater from the septic system. And again, if the test for sanitation is typically about $100, $150, and that's normally paid by the buyer. Okay, and also for the septic system. If the septic system, they're going to want to do an inspection on it, that runs about $100, $150, and it's typically paid out of pocket by you as the buyer. Okay. There's also the foundation inspection. Some loan programs, like a manufactured loan, manufactured home, if you're buying a double wide or manufactured, there's also a foundation inspection that's required by FHA, by USDA, by VA to verify that HUD or that foundation meets all the requirements for that government program, and that typically runs about $500 to $600 for an engineer to come out and check out the foundation and the property to make sure that property is okay. And that's typically paid out of pocket by you as the buyer if you're buying the home. And so those are some of the fees that are associated with the inspections of a property. All right. So I just want to make sure you guys are on the same page about what these fees are. These are prepaid expenses that are typically paid out of pocket by you as the buyer. The seller can pay for it too, but normally the buyer pays these costs. All right. So there's also, now that we've talked about appraisal and inspection, the next thing I want to talk about are the lender fees. Okay. And these are negotiable and depends on the program, depends on your credit, depends on the time of the year, the market, but you have points, you have loan origination fees, you have underwriting fees, you have processing fees. Okay. And these are the lender's fees. All right. Now that varies from, agency to agency, company to company, bank or credit union, broker. So you're going to want to find out how much are those fees and what are they, right? Because the way that we structure our loan programs is you can do zero fees. You can have some programs with fees, so you're going to want to know how much are they, because why? Because this is going to impact you and how much your closing costs are and how much you have to bring to closing. So you're going to want to know how much are these closing costs and how is this going to affect me. Typically for points, that is a buy down on your interest rate. So if you're paying points, that means you had to buy your interest rate down. For example, if the market rate is at 5% and you want a 4% interest rate, you would pay points to buy down the interest rate. So usually you'll pay 1 point, which is 1% of the loan amount, for typically like a 0.25% movement in the interest rate. So if your loan officer says, well, I'm going to charge you 1 point, that's, that means that from 5% to 4.75, it's going to cost 1%. So if you want to go from a 5% to a 4.5%, that's going to cost 2% of the loan amount. So if you're buying a $200,000 home, you would multiply 1% is $2,000. So 2% is $4,000, and those 2 points would take you from 5% to 4.5% on your interest rate. So that's how points work. The other thing is that this is it's called prepaid interest, so it's a tax write-off, and you would try to finance. You can finance that into your loan, or you can pay it out of pocket. Okay, and some loans don't have. A lot of loans don't have points, but some loans do have points. If you have a lower credit score, your loan could have points on it, but it can typically be paid by the seller or financed into the loan or paid out of pocket by you. There's ways on how to work around that, but that's how points work. Okay, and it's a tax write-off at the end of the year. You can actually write that off on your taxes, which is really cool. Loan origination fees are different. That's to consummate or to start the loan, to originate, to make the loan, and that's also percentages of the loan amount. So like with us, we have programs with no origination fees, and we have some programs that have origination fees to start the loan. It just depends. We'll give you the option. Normally, like with us, we always give people the option. Some companies, they charge origination fees regardless. And basically, the way it works is let's say that you're buying a $200,000 home, and the lender says, well, there's 1% origination. That means that 1% times the loan amount is $200,000. That's how much you're going to pay in origination fees, and that can be paid by the seller. It can be rolled into the loan, or it can be paid out of pocket by you. But that's how a loan origination fee works, is to originate the loan, to make the loan. And like I said, it can either be financed into the loan, or it could be paid by the seller or out of pocket by you. But it's typically you multiply a percentage times the loan amount. So if you're buying a $100,000 home, and you have 3% in loan origination, your total loan origination fees would be $3,000. Okay, so it just depends on the type of program that you're doing. But that's how loan origination fees are structured. And again, each company is different on how they're going to charge you and how much it's going to be. But you shouldn't see typically on points and fees. It's kind of excessive if it's more than 1%. If someone's charging you like 2 or 3 or 4%, that's really excessive, and you shouldn't be charged that. So if you see that on a quote or an estimate, that you're probably paying too much to get your house. So just keep that in mind. The other thing is the underwriting fee. This is for the underwriter to underwrite your loan. And basically, there's usually depending on what type of loan you're doing, a government underwriter or senior underwriter that's underwriting your loan for you to determine your loan approval. And they have to be paid to underwrite that loan. This fee is passed on to you as the buyer. And basically, that fee can be anywhere from $495 to $1,500 is a reasonable range. If you're paying more than that, it's too excessive, and I would not pay that. The sweet spot for that's usually about $995. I would not pay, anything more than $1,495 for an underwriting fee. Our programs, we have programs with no underwriting fee and some that do have underwriting fees. So it just depends on, what program that you're doing. But that's normally the range for underwriting fees. So there's also a processing fee. This is for the processor to process your loan. And typically, this is for the person that works right before the underwriter to have them process your file. All right? And they have to be paid too. It's a human being, a person. That's their job to get paid. And basically, that fee can be anywhere from $495 to typically $995. All right? And so if you're paying more than $1,000 for a processing fee, it's too much money. Don't do it. It's normally not ever below $495. That's a normal range for processing fees. With us, we have programs that have no processing and some that do. It just depends on what product that you go with. We can also waive our processing fee, or you can have it on there. It's up to you based on the program and the eligibility, if it's either USDA, FHA, VA, or conventional. So but those are the normal fees that you're going to see for lender fees. Now, the next thing that you have agency fees. So this is to the government, for the different sector, either FHA, USDA, VA. Conventional loans do not have an agency fee, but the government programs do. For example, an FHA loan has a fee of 1.75% that goes to the government to give you the loan. Okay, and that gets financed into the loan, or you can pay it out of pocket, or it can be paid by the seller. VA loans, veteran military loans, have a fee of 2.15%. This can, again, be paid by the seller, put into the loan, or paid out of pocket by you. Most people, 99.9% of people, just have it rolled into the loan. If you're a disabled veteran, that fee is waived for veteran programs. And the USDA has a fee of 1% that gets financed into the loan, okay? Or it can be paid by the seller or put into the loan. And basically, this keeps the Treasury, keep their doors open, pays for employees, and all of that stuff. It's non-negotiable. It's a mandatory fee. Unless, again, you're a disabled veteran. For VA loans, you can get that waived. But the thing that you have to keep in mind with these settlement fees, like I said, they do keep the government open. It's not a lender fee. It's not a scam. It's not a fraud. They're real legitimate fees to allow that loan to occur. you have to pay it. But it's never going to be more than 1% for USD as of right now. And for veterans, it's 2.15%. If you're using veterans, if you're using your entitlement again or refinancing, it could be 3%. And if you're doing a streamlined refinancing, your veterans usually 0.5%. And so, and typically, like I said, it gets financed into the loan. Okay, you don't pay it out of pocket. I mean, you can if you want to. The thousands of loans I've done, most people just they have it rolled into their loan, and they don't even think twice about it. It's not a big deal, right? But that's what agency fees are, and you'll see that on your loan estimate. And after I'm done talking about this, we'll actually pull up a loan estimate so you can actually take a look at it. The other thing that I want to talk about next is you have escrow for property taxes and insurance. This confuses a lot of people. When you're buying a home and you're not putting 20% down, you have to include your property taxes and your insurance in your house payment, okay? So your property taxes and your homeowner's insurance, your HOA, all that stuff has to be included in your house note. And when you're buying a home in the beginning, you have to put insurance prepaid of 15 months worth of insurance into your escrow account to start the escrow account. So it's 15 months. So if you're buying if the insurance is $100 a month, you have to put in $1,500 up front into your escrow account to start it. And you can either have that financed into the loan, ask the seller to pay it, or you can pay it out of pocket. You typically also, in 90% of the states in the United States, you have to put 3 months of property taxes in there as well. The reason why you have to do this when you're setting up an escrow account is because whenever the lender is managing your property taxes and your insurance for you, they want to have a reserve, a cushion, in the event that when your property taxes are due and your insurance is due, that they have a savings to be able to pay those property taxes and insurance at the end of the year. So they're going to require that. But states like New York and Pennsylvania, they may want up to 12 months of taxes prepaid, property taxes. So it can be very, very expensive in those two states, or Vermont, when you're trying to buy a home, because you have to prepay for the insurance, you have to prepay for the taxes up to 12 months as well. Okay, so again, going back to the taxes, it's whatever the monthly taxes are. Let's say the taxes are $300 a month times 3 months. That would be $900 that has to be put in that account, plus the 15 months of homeowner's insurance. So if the homeowner's insurance is $100 a month, that's $1,500 plus the $900 is $2,400, and that has to be put into that escrow account. Okay, and so and normally, like I said, with how we do it, the seller would pay for it or be rolled into the loan, or you could pay out of pocket if you're the buyer. If you're doing a conventional loan, you're putting 20% down. You don't have to escrow your property taxes and insurance. But if you're doing FHA, VA, or USDA, you have to include your property taxes and your insurance for your escrow account. This has to happen. It's non-negotiable. All right. You can choose whoever you want for your insurance. That's fine. We do insurance too. We normally are the lowest rate, but you can choose whoever you want to do your insurance. But that's normally how it works when you're doing a government loan. All right. So one thing I want to talk about also about the agency fees is those are percentages, guys, of the loan amount. So like with FHA, it's 1.75% multiplied by the loan amount. So if you have a $100,000 loan, that's $1,750 that would get rolled into your loan. So these are all in percentages what we're talking about. All these things: property taxes, homeowners insurance, agency fees. So the other thing I want to also mention right now is the transfer taxes. And not all the states, but about 20% of the states, when there's a seller and buyer of real estate, there's transfer taxes. Okay, and that's when you're transferring the home from this owner to this owner. There's transfer taxes that need to be collected. Like, for example, in Pennsylvania, in Florida, in New York, there's fees for transferring the title from the seller to the buyer, and those fees are called transfer taxes, and they can be usually anywhere from 0.5% to 1.5%. In Pennsylvania, for example, The seller pays 1% and the buyer pays 1% for the transfer taxes. In Florida, the buyer can pay up to 1.5% for dock stamps on the deed, dock stamps on the mortgage, and the seller normally pays about 0.75%. But there are those transfer taxes, and that's why it's there. It's not a fake fee or a frivolous fee. It does have to be paid. It's a real fee, and it has to be paid. And it can be paid by the seller, or it can be rolled into the loan or paid out of pocket by you, but somebody's got to deal with that, okay? So you'll see it now. A lot of states don't have them, like Texas doesn't have it. Louisiana doesn't have it. So there are some states that do, some that don't. It just depends on what state you're in. Some states have attorneys, like New York has an attorney. You have to pay the attorney to do the closing. North Carolina has an attorney, so there's an attorney fee. In Virginia and North Carolina, there's also a due diligence fee. That's your option period to inspect the home. It's called due diligence. That will allow you to, when you put a contract on a house, give you a 10-day option period or due diligence to inspect the home. So when you put that earnest money down to be able to buy the home, you have that 10-day due diligence to, hire an inspector, have them come out to the property to make sure everything's okay. And if there is a problem, you can get your earnest money back and walk away from the deal and not risk losing your money. Okay, and that's what earnest money is. Earnest money is a good faith deposit to the seller to show your sincerity to buy the home and that you're serious about buying the house. So you would put down earnest money to show your intent, your interest to be able to buy the home. That money is refunded to you typically if you cannot secure financing, if your loan gets denied, or there's a problem with the appraisal, or during the inspection or due diligence there's an issue with the home, you can get your money back. Okay, but normally the seller has the right to keep that money if your house appraises out, you fully get approved, and you decide that you don't want the house anymore. The seller has the right to keep that money, and typically earnest money can be anywhere from $500 to 1% of the purchase price of the home. You never really want to pay more than 1% of the purchase price of the home for earnest money, and typically it's never less than $500. But that's what earnest money is. Okay. Option money is, like I said, the due diligence fee. That's your good faith money with the earnest money. It gives you a grace period to get out of the deal if there is a problem with the home, and you can walk away and get your earnest money back. Okay. So the last thing I want to talk about with respect to fees are title fees. These are the other part of this. Huge proponent of this is that when you go to closing, you've seen Stewart Title, Fidelity Title, Chicago Title. That's where your closing is done. Okay, a real estate attorney, and there's title fees. Okay, they're not lender fees. They're not fees I'm charging you or that the USDA or FHA's charge you. This is to close on your property. So there's two different types of title insurance. There's lender's title insurance and there's owner's title insurance, and there's a difference. Okay, the lender's title insurance is to insure the lender and then to show that title that you're being put on is a clear title. There's no problems with that title to the property, because think about what's happening. You're buying real estate and the title's being conveyed from the seller to you. They want to make sure that there's no liens or judgments or problems with that title. If you buy that house and there's a $200,000 tax lien on it, and now that no one checked that title, now that tax lien belongs to you, you're screwed. So that's what the insurance does, is it ensures that there's no problem with the title, that when you buy the house, hey, it's a clear title and there's no problem with this property, right? So you want to make sure, the lender wants to make sure, hey, I'm giving a loan to this guy, there's no problem with this property. We need lender's title insurance. And the other side of that is the owner's title insurance, where that's insuring you. Let's say that you go buy a house for $300,000 and there's a $100,000 lien on the property from the previous seller, and that lien holder comes and sues you now because you currently own the home. And you're like, what the hell? I don't know what this is. I didn't have a lien. And like, yes, now you owe me the money. And you're like, no, I don't. I don't have any liens. And now they're suing you. Well, that title insurance is going to protect you if that ever happens. They'll cover the cost of an attorney, pay for the lien, and get you out of that issue if that ever happens. And you think this doesn't happen, it happens all the time. So that's what that owner's title insurance is there for, to protect you in the event like something that comes up. And that's what the owner's title insurance. Typically, owner's title insurance is anywhere from 0.5% to 1% of the purchase price. So if you're buying a $200,000 home, it can be anywhere from $1,000 to $2,000. Lender's title insurance is usually anywhere from 1/4 to 3/4 of 1%. So on a $200,000 home, it could be anywhere from $500 to $1,500 for lender's title insurance. These are necessary things that are needed, and so they can be paid by the seller. They can be put into the loan or paid out of pocket by you, but it is something that's needed. And then you have, miscellaneous title fees. You have escrow fee. That's to pay the escrow officer to close on your loan. That typically runs about $300. Don't pay more than $500 for that. And then you have attorney fees. Those can be anywhere from, $300 to $500. I would not pay more than $500 for an attorney fee to process and close your file. Then there's like document fees, doc stamps. Those are usually anywhere from $50 to $200 for those fees. I wouldn't pay any more than that either for those. I'm actually going to pull up a loan estimate now. Please pull up the loan estimate so we can take a look at it. I actually want to show you what you're going to see. When you buy a house, guys, this is an example of a loan estimate. See, it says loan estimate. I'll have the date issued, your name, the type of loan program that you're doing, the type of product, whether it's conventional, FHA, VA, USDA. It'll tell you if the rate's locked or not. And these are the terms here. Let's go ahead and just slowly scroll here. This is the loan terms. Shows you the loan amount. This is the interest rate. This is the principal and interest payment right here. And it'll tell you right here to the right, can these things increase after closing? It should say no, no, no. Does the loan have a prepayment penalty? No. This one does have a prepayment penalty. I don't know how that can happen, but this is a risky loan. None of my loans have a prepayment penalty. A prepayment penalty means if you want to pay the loan off early, you can without any restrictions or obligations. This loan has a prepayment penalty. It's not a good one. No balloon. The balloon payment is that means the whole loan is due at some point in time. None of your loans should have prepayment penalties or balloons. This shows you what the payment is. This is just a principal and interest payment, and then shows you how much the mortgage insurance is, how much the property taxes and insurance are. Then you should see your total monthly payment right here. In this case, the mortgage is $761.78. Then you have your mortgage insurance, your escrow. For escrow means with your property taxes and your insurance. If you had an HOA, the HOA would be included in this, but the total payment's $1,050 a month. All right. This shows you how much the taxes and insurance are and what's included in it. Right. This shows you right here your total settlement charges that we just talked about. Right. And this shows here with the down payment and the settlement charges how much you have to bring to close as estimated cash to close. So here, that's what it is, $16,000, and this is a breakdown on page 2 of what those settlement charges are. Here it shows the loan cost, the origination charge, the application fee, the underwriting fee. We talked about the totals, $1,802. Here, if you look to the right, it shows your taxes and any government fees. The escrow account we talked about for mortgage insurance, property taxes, and insurance is all to the right here. If you scroll down a little bit more, shows you, the appraisal fee was $405. They charged $30 for a credit report and these other miscellaneous fees. And then to the right over here, it should show the total calculations. And you scroll down, here's the breakdown. Total closing costs, $8,054. The down payment was $18,000. They put a $10,000 deposit. And so basically, their net due to closing was $16,054, and how they determine that is $18,000 plus the $8,054 minus the $10,000 deposit. They have to bring $16,054 to closing. So this is a loan estimate. You will be provided one of these. If you're not provided one, you need to get one. You should be provided one of these at the time that after you go under contract. And this should come out to you by your lender, all right? And expect to get that, via email, and somebody needs to go over that with you to explain to you how that works. So that's how it works, with closing costs and the expectations about how much you should pay and how much you should not pay and what to look out for. Be very careful. Make sure that you're getting that and that you've been educated and they talk to you about it. The one thing I do want to tell you, like I said, with your mortgage payment would normally include your principal and your interest, your property taxes, your homeowner's insurance, your mortgage insurance, and if you have an HOA, typically all of those things would be included in your monthly house note. We have something called the rapid pay plan, where instead of paying monthly, let's say the payment, here was $1,000 a month, or if you pay bi-weekly of $500, it'll take it from a 30-year loan down to a 23-year loan and shave 7 years off the mortgage and save you like $50,000 in interest. That's a really good thing if you can do a bi-weekly rapid pay plan, and it's auto-drafted out of your account, and it'll just help you to pay your loan off faster. Really, really good idea. So, I hope that this was enlightening and educating for you. Guys, I don't know if you know who I'm Angelo Christian, nationwide #1 lender in the country. We specialize in helping over 1,000 families that we talk to every single month to get into a home. I've been doing this for 15 years. We're AAA rated with the Better Business Bureau, one of the best, award-winning lenders with the FHA and USDA. We work extremely hard to provide you guys with great content. We have 3 shows that we produce every single week. Real Estate Insider, Learning Hub, and Influencer here to help you, to educate you, to make you smart when you're trying to buy a house, refinance, invest your money, grow your assets, grow your net worth. Please share this information with as many people as you can. Follow us on our Instagram, our Facebook, and our YouTube. I'm Angelo. You can call me here anytime. If you're looking to get help with buying a house, click on the link below to get signed up. If you know someone that is, click on the link below to get signed up. Refer somebody, keep this going, educate people. That's all we're about here with our mission, is to help, as many families as we can to get into a home with the best loan program. If you have any comments, leave your comments down below. Like I said, you'll be able to download a copy of this loan estimate in this segment so you can review it and study it. Leave your comments down below in the chat box. Thank you so much for checking us out. We'll come out next week with another great show. Y'all have been excellent. Take care and peace out and have a fantastic week. All the best with your future and your dreams.